All right, we're here at the Real Estate Roundtable with IPRG, and we have a great guest today, Anthony Morena from Mortar Group. Welcome, Anthony.
Thank you.
Great to see you.
Appreciate it.
100%.
Yeah.
Luke Sproviero's here, and Donald Flaherty's here. This is Derek Bestrick. So, what's happening, Anthony? How's everything going?
Doing well, market's keeping us busy.
Yeah.
And no, it's good to be here. Appreciate you guys you having me.
Absolutely. We were talking briefly before we just started recording that you're a developer, but your background is in architecture.
Yep.
So I think that's great. Probably a very good knowledge base having the architecture to go along with development. And you were saying that architecture just wasn't really where you wanted to be and wanted to pivot into development.
Yeah.
So
yeah, it's it was one of those things. Like I graduated from architecture school, and you start to see kind of the climate of where architects were in the totem pole of development. It's like, okay, that's not really where I want to be. I want more control. Wanted to see what was going on. I wanted to have a voice in the overall system. So I was like, okay, we're going to start to shift into development, but the architecture kind of gave me a good background from the technical side.
Yeah.
So where I was able to kind of see deals a little bit differently than your traditional kind of finance guy would. And that's kind of what created Mortar and what we do, where we kind of combine the architecture and the development, where I could look at a deal from a technical perspective or just having knowledge about zoning. It's like, okay, you know what, I could squeeze 10 to 15% more sellable floor area out of a deal just because I knew how the code works.
Yeah. So
that early on in my career, because I've been doing this, almost 25 years at this point, so early on it was really helpful.
I'm sure.
And then I went to go work for an architect down here, Joseph Lombardi, who kind of did architecture and development. So that was kind of my first foray into the development world. And then after that, went to work with Morena Group. And that was, early 2000s, 04, 05.
Okay.
When Joe Morena was kind of, starting really to take off and be really busy and really active. So we were doing, 40-story ground-up construction projects. So I got to learn development from kind of the best of the best. And then after that, kind of pivoted into Mortar and doing what we do.
What were you doing for Morena?
Project manager.
Okay.
And it was, at the time, it was a really small group. There were, 10 or 12 people in that office. And everyone was just really busy with a lot of work going on. So you got to see every part of a deal, And I was more on the construction side, but you got to see everything and how, like, a really good developer does a deal. How do they look at it? How do they analyze it? Where do they find the value that were me as an architect? I brought kind of a technical expertise and I could see value that way. But how did guys like that really look at deals? So it's kind of like, for me, it was like the combination of those different things was kind of the precipice for.
Out of curiosity, like a lot of the developers we speak to, especially in Brooklyn, are more of like a boutique condo developer. I'd probably put you in that category, right? But like a Moynihan, right?
Yep.
And you were in the office doing a 40-story building. Why one or the other? Like, is one better? What's like the benefit of doing the bigger projects versus like the boutique condo developments?
It depends, and early on I had to decide kind of what way I wanted to go.
Yeah.
But ultimately there's no difference in doing 500 units at a $500 million or doing 20 units in a $10 or $20 million deal. There's more zeros, but the process is the same. Development, it's kind of a template. You refine it as you go and you get better, with each deal, but they're all kind of the same. And then for me, early on, I was like, I like multifamily. I like residential. I want to focus on that. And then I kind of grew up in Brooklyn, knew it like the back of my hand. So it was kind of like the perfect combination. And then I liked doing the smaller deals because for me as an architect, I could extract the most value out of those.
Got it.
And it just happened to be in Williamsburg, and my first project we started, it was 2001. So it was a long time ago.
Oh, wow.
And, we did a ground-up construction project, which should have taken 3 years. It took 5 years because I didn't know what the hell I was doing, and at the time, we did a 6-family ground-up construction project, but there was only one other building in that area that was for condos. Like there was just no condos in Williamsburg at that time.
Yeah, I believe it.
I think there was a deal, a building it was like on Richardson, that was the only comp that we had. It was like $350 a foot for condo sales.
Get out of here. And
And
that
it's
was in
like you're trying-
2001.
Yeah, you're
I
trying to
believe it. Yeah, it's great.
And you're trying to figure out what is the value of this building, and then all of a sudden you finish the project and you got 100 people lined up for open houses,
Yeah.
and that's where you start to see the snowball of that whole area.
So on $300 sellouts, what was the dirt?
That was not much.
Yeah,
the
jeez.
construction cost $90, $100 a foot.
That's a difference.
Yeah.
It was
Yeah.
a different world. But that's kind of where I kind
Yeah.
of cut my teeth with and kind of, you get started. And I just liked the neighborhood and kind of watch it grow. And then you kind of see it through the evolution, the high points in the market, the downsides, '08, stuff like that.
Mm-hmm.
And just kind of, grew into it a bit.
So it's all pretty much the same, right? So I guess also on the bigger sites are harder to get, right? Like Williamsburg is full of these 25s, 50s, but to get like a big site where you could build a 40-story building, I mean, that's, if I was a developer looking to do that stuff, I mean, it's hard to get the right site. So how long are you sitting around like waiting for this site versus like how many times can you buy?
Yeah.
So
And plus, at the time, I was 25, 30.
Yeah.
So I didn't have the capital
Yeah.
to do those. So you literally have to start one small project.
Yep.
Then the next.
Yeah.
Then maybe try to do two more. It's this slow evolution and slow burn into building it out.
yeah.
It took a while to build a track record. For sure. It was good.
Real quick, before we start talking more about mortar,
Mhm.
could you just elaborate when you're talking about Joe Moinian and when you say he's like building these big developments and where he kind of like sees the value,
Yep.
or like when you say like just dealing with like a very professional developer, like some of the takeaways or kind of what caught your attention from dealing with him?
He just has an eye and he had an eye and a knack for it. He knew what he was looking for. He knew, and he still does, like the branding on how to bring a product to market that people will like as a resident, but also create value for investors and just as a good product. When I worked with him, before that I was at Joseph Pell Lombardi, who was in Tribeca. He was an older guy that had been one of the first guys to do warehouse conversions to residential in Tribeca. So it was just like you start to see these different developers and what they did and how they do it, and it's all kind of the same language. You're trying to create value for your investors, but you're trying to do something that is interesting, stylish, and that people will like the end product. So it was that, and it's just and then just having kind of the guts to do it. That was the big thing. It's just you got to go for it. That's kind of one of the biggest things.
I like that.
Yeah.
So it's so true.
Yeah, it's you can play with the pro forma till you're blue in the face, but at a certain point you got to go, and you're going to learn some stuff. You're going to screw up some stuff, and then you just learn deal by deal.
Yeah.
But just seeing guys do it at that level, where he was doing those size projects, and just the growth of his company at that time, and then continued well past it. Obviously, it was just great to see in my 20s. Yeah, and then I kind of refined the idea. It's like, okay, what do I want to do? What do I want to do in the field? And still keeping a little bit of the architecture background that I went to school for, so you don't waste my college degree.
Yeah.
So it was like, let's get licensed as an architect, use those skills, and then try to bring my version of development into the market.
Cool.
Yeah.
All right. So at Mortar, you're building condos to sell, and you also have rental product that in many cases you're building or renovating, rehabbing, and then you're holding and cash flowing.
Yeah.
Let's start with talking about like the condos and the condo market and stuff that you're selling. And we're at the end of September, middle of September right now. The Fed just cut rates again for the fourth time in the past year. I think rates are down 100 basis points in the past year, something like that, maybe a little more, actually. But I don't know. What are you seeing in the condo market right now?
It's been interesting. It's been an interesting few years for me, and I think every other developer.
Yeah.
You're constantly tracking rates, seeing where things are going. The condo market was slow. You had a lot of deals going on, but not significantly less than you would in a good market. But now it's started to pick up. Sales are picking up. We had spurts of it kind of happening last year a little bit. Like the more interest rates would get close to 6%, the more they would tease 6%, you would see more activity in buyers. So now we're finally going to start to get back to that range when I think there's so much pent-up demand, there's low inventory on the condo side. Ultimately, you're going to bring all those people back to the table on the sales side, and you're probably going to have a bump in prices.
Yeah.
That'll come with it. Because on the flip side, on the rental side, rental prices went out of control in the last 3-4 years, and people that were buying apartments decided to rent an apartment, and then now I think they're going to start to shift back into the sales, which they were originally looking to pick up.
What size units are you building or targeting, or like what price points? Like, where's the sweet spot in your opinion in the market?
So for us, we're kind of a small to mid-cap kind of company. We look at deals that are, I would say, 5-10 units to 40 units. That's kind of our sweet spot. And you're looking at, for us, we've done work, Manhattan, Brooklyn, Queens is our space, but mostly Brooklyn. And I think you're getting a lot of sale velocity in the larger units, 2-3 beds that have been moving well at a good price point. 1 beds are also doing well, but not at the same velocity. But I think as rates start to come down and kind of then enter into the 5s, I think you're going to start to see that pick up as well. Because, coming out of COVID, you had, the rental market was, let's say Williamsburg, Greenpoint was $2,000 to $3,000 for a 1 bed, and then now it's at $4,500, pretty steady. So I think you're going to start to see that whole market shift again, but on the sales side. So we're excited for it. I think the Fed yesterday, or the Fed kind of in the fall, kind of starting to lower rates, and you see where things are going over the next 12 months.
Yeah.
The velocity they drop rates, we don't know, but it's all trending in the right direction finally after a few years of waiting around, and I think it's going to start to build up. So projects that we're taking on now are selling faster, earlier. And I think there's a good buildup of work that we have for like end of 25, 26, and then going into 27 that will do pretty well.
Yeah.
So yeah, it's good. It's a nice turnaround, nice change in the market to see over the last few months.
For sure. People have said that real estate has been in a recession for like the past 3 years, ever since rates started to go up. But it's interesting because I think sale prices, as far as I could tell, are at all-time highs in terms of price per foot. I mean, I'm not
for condos.
No, I would say that for residential units throughout Brooklyn.
Like rents.
No, sale prices.
Sale prices, that's what I meant.
Yeah. Price per foot on sales. So
For condos.
it's in
Either
condos, townhouses, just the residential market.
Not apartment buildings, but yeah.
Well, it depends, yeah. It's interesting to think that rates went from basically 0 on the Fed to over 5.
Yep.
Which basically caused what people say is a real estate recession, right? Like real estate values, they're saying, across the nation are down. Meanwhile, in New York, I feel like there's still so much demand on the residential side of things, and stuff is selling for all-time highs. And I think it's just an interesting dynamic going into the fall and the next year where, rates are coming down. It's pretty clear.
It's interesting, though. Like, I don't track the Manhattan market, but is that the case in Manhattan, though, for condos in Manhattan? Because Brooklyn, obviously, we're very close to it, right? Williamsburg's been insane. Sure. Like, you're seeing $2,000 a foot now in a lot of locations. Yeah. But Brooklyn, like, I live in Tribeca. Like, I don't track that market, but I'd like to. It'd be interesting to see. I think the prices were bigger on these condos in 19 and 18, but
I think it's all kind of correlated, together. I think they're all kind of following a similar trajectory.
Yeah.
We had, you had such low rates for a long time, and you had a stable buyer pool.
Yeah.
And then the rates shot up unexpectedly in 22 at such a high clip. No one was really ready for it, and depending on what kind of deal you were doing, you could have got wiped out, you got killed, but the prices on the sales side did not really go down much, but the velocity dropped significantly in 22, 23, and then now you're starting to see it kind of trend back up in the right direction. And I think once we hit certain milestones with rates, and it always takes a little bit of time between rate drops and buyers to kind of come back to the market and feel comfortable. Is that 3 months, 6 months? But I think that's it's all building up to put us in a good position. I think for New York in general,
for sure,
for the next couple of years. Rental's trickier because it depends on what kind of rental asset you have and all the politics and all the other stuff associated with it. But for good markets, I think you're in a good position coming in.
And do you think the velocity was down because there was less demand to buy, or is it like there was a lack of supply because people just weren't selling?
A little bit of both.
Yeah.
I think it was the market kind of froze up. You weren't seeing too many new deals coming to market that you could develop. Buyers were on hold where they're like, I don't want to spend X amount and buy a condo or a townhouse at 7 or 7.5%, where your mortgage rate would have been double what it would have been 3 years before. And I think that was also kind of a shock thing where people weren't ready to make that jump. But now, because things are starting to come back down, you're going to see that kind of that movement again. And instead, I think those people went, the people that were on the sidelines and buying, they switched to rentals for a short term. It's like, okay, I'm going to rent a place, great spot, Williamsburg, Greenpoint, Manhattan, Tribeca, where it might be. And those rates went up as a result. And now I think you're going to see the sales stuff kind of follow.
Got it.
I've been wrong before, but that's kind of...
I was listening to something earlier that said that we're like at the start, like the very beginning of a new cycle. Like we're about to enter, like this is the start of a new cycle, a new boom in real estate. Do you think so?
I think so.
Yeah.
Yeah, I think it's there's a lot of different things that are going to come together. I think New York is kind of, everyone was kind of concerned about New York for a bit, and it's like, what's it going? But I think, New York is doing well. Everything's kind of taken off. The timing is kind of moving in the right direction. And now for us, it's finding deals that make sense that you can kind of really jump into. We had a lot of, for us in general, we have a rental portfolio that we manage, that we hold on to, and deals that we'll develop as rentals. But then we also do kind of a mix of either ground up construction or kind of renovation or value add type stuff. So we were earlier, a few years ago, we were more shifted towards the ground up construction stuff, and then we shifted a little bit more towards renovation stuff, just because we could pick up more of them and just fit in with the rate market. And I think now you're going to start to see more ground up stuff kind of come to market, and kind of you'll see all that kind of move. But yeah, I'm excited about it. I think it'll be pretty good.
Yeah. And are the condos all ground up, or do you do those like in existing buildings as well?
We'll do them in existing buildings, where we'll take a smaller building, add on to it, double the number of units, change up the unit mix, just update, modernize it for what the market's looking for. So we'll do a little bit of everything. Kind of depends. It really you follow the flow of the market to a certain extent. Where things are, where they're going. You try to push out, a couple of years and kind of get a sense. The problem with ground up sometimes is, it'll take 3 to 4 years to build and then bring to market. So the problem we had was, with any developer that started in 20 to 22. And you had a construction loan at 4%, 4.5%, by the time you're halfway through construction in 23, 24, you're at 9, because it's just floating debt.
Yeah.
It's just, they killed those projects. So
for sure.
So it really depends on what you were doing and how much equity people had in deals, how levered they were on debt, and stuff like that. But for us, we tried to maintain a good balance where we can kind of bounce and pivot with things as they went along.
Yeah.
Makes sense.
Yeah. Do you feel like there's a lot of demand for the condos in the market, and also kind of going along with that, like who are the buyers? Like where are they coming from, and like where is their money coming from? Like what is the demand side of the market kind of look like?
It depends. It depends on the product and where it is. We have condo developments in Astoria, which is a very different kind of market than Greenpoint, Williamsburg, or we just finished up a project in Prospect Heights. So very different, all three very different marketplaces. Astoria is kind of like you've got buyers from Long Island City that are looking for something that's a little less expensive, a little more space, a little more bang for the buck. You've got Williamsburg, Greenpoint, which are could be people from Manhattan that are kind of shifting in, or the people that have been living in Williamsburg, Greenpoint forever, and then they get married, you have a kid, now you're concerned about a school and a larger space, so you start to see that. And then Prospect Heights, Park Slope, it's your school, bigger apartment, 3-4 bedroom, higher valuations, just because there's less inventory there because it's more landmarked. So you've got it's harder to find a new deal or a new building that you can kind of live in. So it really depends, but they're all kind of trending in an interesting way, which is nice to see. Yeah,
for sure.
Yeah.
I feel like in terms of school, the big gripe on Williamsburg Greenpoint is the schools. That is the big issue that a lot of people, I think, that are looking for condos for 3-bed, 3-bath, like willing to put their family and buy a condo for a lot of money. That's the Achilles heel for that area.
And it used to be worse because as the neighborhoods were kind of coming up, there was very few options. Now they're getting better. Now you have private options. People commute a little bit more. COVID kind of changed things a little bit, where how people work and spend their time during the day. So, but overall, it's gotten better, and the market for those larger units has grown substantially. Like even with deals that we're bringing to market now on the condo side, the velocity that we're selling a 1,500 square foot condo is a little bit faster than your one bed or your studio. Usually it was always the other way around, like the one beds you'd sell them faster, just lower price point.
Yep.
But now someone's spending $2-3 million on an apartment that's larger that fits their needs. A lot of cash buyers you're seeing. And I think that'll start to shift, obviously, with rates. But yeah, it's an interesting mix that you see coming in. Yeah.
So you think the cash buyers are because of the rates?
Yeah.
Now,
Yeah.
I obviously agree. I think the rates have something to do with it, but I think it's a lot of inheritance too. Like we saw that a lot in Carroll Gardens. We sold 2 townhouses to users, and these people cut checks. They also, I don't think they could get mortgages because they're inheriting the money and they don't have good jobs. So they can't get a mortgage just because you have a bunch of cash. They have no income.
Yeah.
So they had to do that anyway.
Yeah, you definitely see an interesting kind of blend of that.
Yeah.
So I think it's a lot of that too.
You had a lot of cash buyers the last couple of years were looking for deals.
Yeah.
They're like, okay, I'm coming in cash.
Yeah.
I know the market's a little bit slowed down of last, so I want to get a good deal.
Yeah.
I'll sell it in a year when rates come back down, or then I'll finance it then and pull my money out. But you definitely see a lot of like the inheritance stuff, gifts, couples getting married, family money kind of buys the apartment for them. You see a lot of that kind of stuff.
Yeah.
But that's kind of the beauty of it.
Yeah.
For years it was kind of like it was like foreign capital, foreign equity was coming in. That slowed down, I think, just because of COVID and everything else. But I think that's going to start to pick up as well. So yeah, it's a good mix that you see kind of popping up now.
Yeah, the bigger units are interesting. I have a need for that. Obviously, I have kids, but I see it everywhere. If you look on like Street Easy today, like big units, if you need like a 3-bedroom, let's say 3-bedroom or 4-bedroom, like you are not looking good. You have very, very, very little options. Maybe in the buying, there's more options, but it's crazy that people are still building these small units. I think even people that are even with a girlfriend or boyfriend, whatever it is, they want more space.
Yeah, and then you see buyers that'll take 2 1-beds and they'll combine them into a 3.
Yep.
Yeah.
You see that kind of thing. So yeah, it's definitely kind of flipped a little bit. So the nice thing about doing the renovation or rehab deals is you can be in and out of a deal in 18 months. Like, so some stuff that we bought with you guys, we're coming to market already. It's just kind of fast turnover. The ground up construction takes a little bit longer. So if you've got to pivot in your unit mix, it's kind of hard. But with a deal that you're coming to market 12 months after you bought it, it's just you can catch the market faster.
Got it.
So that's kind of what we try to focus on at this point, just velocity. Doing a lot of smaller deals, but just getting in and out of them faster. It makes the underwriting easier, makes investors happy, because they're getting their capital back, they're seeing gains, they're kind of, everyone kind of gets excited about stuff. And you can catch the market at the right time, which has been good for us.
Those are for condos.
Yeah.
Renovate. Okay, got it.
Even rentals though too.
Yeah.
It's the other thing is on the rental side is like it took a couple years to kind of digest the fact that rates suck and they are what they are. You gotta accept it, and then you start to change. Rates go up, but the pricing dynamic for an asset, a deal you're trying to buy, doesn't really change that much. Like, they're still expensive, not too rate adjusted. Then prices start to come down a little bit, and now you start to see more velocity. So I think now that combination, helps, and I think it works well. And the rental values have been strong. That's the other thing. Rental prices have not dropped. They're going in one direction. The politics and everything else in New York, which makes it sticky at times, has also driven that market even higher. So I'm curious to see what happens on the rental side. But if I take past history, it's going to continue in one direction. It might slow down a little bit, but when we bring rental deals to market now, you're leasing them in a couple weeks. You're going to get you're getting 5 offers on a 2-bedroom, on a 3-bedroom, 5 offers in one day. And then you're just moving on to the next. You recapitalize, and you kind of just keep going. So it's nice.
So what's the business plan on the rental side? It's to buy buildings that are vacant and renovate, and then just put them back on the market and
so we
cash flow and hold it.
It's a combination. Depends on the deal. We'll have some that we just kind of put into our portfolio. Okay, we're keeping this for 20 years, and some that we'll buy, reposition, and then kind of just have a sale in 2 to 3 years. and that's it's always kind of been this blended model, really kind of depending on what's going on.
Yeah.
And what works well from, the cap rate side. Cap rates got crushed a little bit with some stuff, so it's like, okay, we can be a little bit more patient. We can wait till 26 to 27 to start to sell. But the rental numbers have all kind of been working in your favor. You just need rates to kind of cooperate a little bit.
For sure.
So now you're starting to see that. So I think you're starting to see more velocity. And for a while, you didn't see a lot of new deals coming online. Because for us, if we're doing smaller stuff, you have to be a little picky in kind of what deal you're buying, where it is. If you're looking at sub-rehab stuff, you got to be pretty meticulous on how you're looking at that stuff and if you're evaluating correctly with, just city-state guidelines and all that kind of stuff. So you have to do your homework a little bit more, but if you can get a good deal that works out well, I think it works out for everybody.
Yeah. And then are you guys into so you buy, you renovate, and then you refinance, you pull out your cash and basically just sit and hold, and then what about 1031s? Are you guys doing that?
Mm-hmm.
Okay.
Yeah, we'll do that. Early in my career, the way I would do it is it was kind of 1031s to build up the rental portfolio. Like you finish the development deal, you 1031 into a rental. And it's kind of always kind of recirculating capital because you're starting. For me, you're starting from zero. I don't come from like a real estate family or background, so it was kind of always kind of you got to hustle a little bit and try to figure out how to just build that base. And you get lucky sometimes, and you just kind of keep growing it. So 1031s have been a big part of it. And that was also quiet for a little bit. Now you're starting to see that happen again. Bonus depreciation was a big thing, and then that kind of died down. But then that's back, so it's all right, let's go. We're ready to go, and that just helps.
Great.
Yeah, so that helps you just evaluate deals where if the acquisition price was a little tricky, now you can navigate those prices a little bit better. And for us on the construction side, we do a lot. We don't do the construction in-house, but we have contractors that I've worked with for 20 years. Contractors are always a little finicky. Everyone's got their issues, but if you have good teams and you can turn around deals fast, it makes you more efficient. You can be more aggressive on the buying side.
That's what we hear. You see us here on the phone. We were talking to a developer, and his dad's a big developer. And he has friends that obviously are doing this a lot. And if you have those pieces together and you get what you're doing, the price per foot doesn't really matter as much, right? Like if you don't know what you're doing, you have to really buy cheaper. But $100 a foot, if you have the pieces in place, doesn't really move the needle that much.
No, that's the thing. For us, if we look at a deal now, you can identify in 5 minutes if it's going to work or not. You don't need to get into all the nitty gritty. You don't need a full pro forma. You know what the comps are. You know what it's going to cost to build it. You know your soft costs. You know your debt. Does it work or not? And it's like, all right, let's go. That's why I like working with you guys. It's just kind of like, you see a deal. It's like, all right, let's put an offer in 15 minutes. Let's just kind of, you know what you know. But it took a while to kind of figure that out. Again, after doing it for a while, it gets a little bit easier. For us, we still do the architecture and the design in-house. So once a deal comes in, we'll do the initial underwriting, see if it makes sense, and then it goes to the architecture team, and then they bring in the construction admin side, and just and then the development team, and then it's off to the races, pretty fast. That was always one of the nice parts about bringing architecture and development together. It's like sometimes if you are a developer and you've got to make a change, you've got to value engineer something, you got to call the architect, he's got to call the engineer, you got to call the contractor. It's 2 weeks of back and forth and no one knows, it's just you have to figure it out. For us, we could sit down, we make a decision in a half hour, and we go. So it's just we've been built for kind of velocity and just kind of move fast in that way, just because we've done so many of them. I think this year we're kind of working on our 40th development project. So now we've got a pretty good base of historical data that we kind of just go back to and kind of see what works, what doesn't.
And people like you, it's so easy to deal with because you're a developer and architect, but also we have developers and general contractors, which are also very easy to deal with because they know everything. And I feel like if you're not one of those two things, you can't. It's it takes so long for us to even get an offer from you as a developer. So it's much easier that way.
The GC stuff, that can kill you.
Yeah.
I mean, it's all about the
That's-
foundation.
that's it.
Like,
That's what I
that's the
was
scariest
told. The
part.
foundation is the hardest part, right? Like the rest of the building is easy after that.
You know, it's
Getting it off the ground.
that's the hard part. Like the architecture developer model is good. The GC developer model is even better.
Yeah.
You know, at some point in my career, a few times we were like, maybe we should do construction in house, but I was like,
Yeah.
got enough headaches. My hair's gone already. I'm like, I don't need any more problems. But that way, it's like you're saying, it's like when you've got a ground up construction project and you get out of the foundation phase, it's just like, this is lovely. It's like,
Yeah.
all right, let's do superstructure. Let's get this thing enclosed, and then you're going.
Yeah.
It's that early phase where you've got neighbors, you've got city agencies, you've got all this stuff you've got to navigate, make sure you do things the right way. You got insurance, all these kind of costs, and the general contractor that's managing that project is extremely crucial. Like if those guys are doing it in house and they can manage their schedule and they know I can be in and out of this foundation in 3 months, 4 months, versus getting lost in it in 6 to 8, that's huge. And especially when rates go up, that money is you're just getting killed. It's all coming out of the back end. So it's a huge piece to have for developers.
It's a big X factor. I mean, I still to this day, obviously, we sell a ton of them. We're very happy to sell them, but the ground up stuff, so many X factors, like just the access agreements, like that's not even a guarantee. I mean, eventually they have to give it to you, but everyone closes like without them. I mean, they try not to. Obviously, I think that's the point of the long closing. Besides the architectural drawings and all that, but just that alone, it's just because you have to get it from sometimes both sides. It's just crazy.
I know developers that give their GC equity in their deals just so they're in it with them.
I mean, it's smart.
It's a smart move. It's like because that's how important they are.
Yeah, no, we've done structures like that in the past where it's like an incentivized bonuses and stuff like that.
Yeah.
Just to try to get everyone on the same page. Because
Yeah.
when a deal goes well, everyone is happy. There's always going to be bumps. Like when you close on the deal, everyone's excited. But at a certain point in the process, all hell's going to break loose. If you're all kind of unified on that path, and you get to the end and everyone does well, it's a great way to do it. And the older I get, I try to avoid as many headaches as possible. But access agreements are still one of them. It went from like you didn't need an access agreement to you needed a little bit more. You needed something. You needed a letter. You needed some sort of communication. Now it's formal access agreements, and then it just gets tighter and tighter. And then some neighbors try to take advantage of that. And so you've got to navigate all those issues, but you've got to do it right at the beginning now. It's like you got to plan for it. You got to plan for it. It's baked into your cost. It's part of your budget because if you might have some more work to do the first 3 months, but if you don't do it, it's going to make your life miserable for the next 2 years. So it's huge, but it's one of those things. It's tied into that foundation.
Yeah.
Once you get that foundation done, if you've got an underpin, you get all your concrete work, your steel work done, you get superstructure up, then all of a sudden it's the game flips, and then you kind of you can finish interiors pretty quickly if you got a good team, and you just hammer out a project fast. And then if it's rental condo, you just bring it to market, depending on what you're doing. And then the sales team is important on both. Like on your side, kind of where you're selling the deals, but also on the exit side. Who's that team? Sometimes it's the same, right? We work together in that respect. Those are huge parts, and it's like having that network to work with makes your life so much easier. There's always pros and cons to every group you work with. Me as a developer, someone could say there's pros and cons. Some contractors, they're not perfect, but I know they can get a deal done in the time that they say. And you can trust that they're going to do a good job. You know the kind of work that they do. It's like, okay, I got to keep an eye on them when they do tile work, but I know they do kitchens really well. They do steel really well. So you start to kind of pick and choose your teams that depending on the deal, and then that's how it kind of all comes together. And hopefully it goes well. Ultimately, it's up to the real estate gods to determine what's going to happen.
For sure.
So you think the foundation for these ground up, that's the hardest part?
Yeah, you got to get through demo. You got to get through the foundation part.
Yeah.
And then it's because when you're modeling your pro forma, your contingency is going to get eaten in that phase. If it doesn't, unless you're making changes as the owner or the architect screwed up, there's not much variation in that contingency after the fact. It's all kind of gets eaten up in that phase. There's projects that we've done where you design one foundation, and it's like, okay, we're going to do a traditional concrete structure. Then you start to dig, and you hit water in 6 feet.
Yeah.
It's like, okay, this is a problem. That structure doesn't work anymore, so you've got to redesign it, and it comes a lot more expensive. Or if you've got to switch to piles, piles are a nightmare. It's one of those things, kind of like access agreements. It used to be a lot easier to navigate doing piles in New York City. Now it's a lot more complicated, a lot more expensive. So you got to try to figure out all your variables in-house. Where that being the architect or having that team in-house has kind of helped us. But yeah, you're always, you're surprised sometimes when you dig a hole and it's like, oh, I wasn't planning for that.
Wow.
We did years ago, early on, we did a project in Vinegar Hill, and we're doing demo and excavation for foundations, and there's a buried car underneath there. It's like, okay, we didn't plan for that, so we got to get this car out of here.
Yeah.
It's a contingency item, but yeah, you never know.
And then when you hit water, it's basically you're building a pool, right? Because you're inlaying this whole structure and you're lining it like a pool.
Yeah.
And
it gets messy, and then depending on what time of year you're building that foundation, water table's high, low. Greenpoint, Williamsburg, Astoria, there's a lot of fill. So you got to understand where you're building, what's the history in that location. So it's I've been burned on that side, and we've been fortunate others, but yeah, you kind of learn to look for the pitfalls, and you try to hedge against them as much as you can, but it's never foolproof.
Wow. So what's one of the more successful endeavors? Like, what you have to get the name of the project, but what's one of the better ones that you've done recently or in the last couple of years?
So we've had a few. We've had some that have taken a little bit longer to sell.
Okay.
We've had some that have done really well and sold really quickly. Prospect Heights, great location, beautiful building, turned out really well. Contractor was great and sold most of it really quickly. Greenpoint, Williamsburg, same thing. If you get that unit mix right and you time it right, they worked out really well.
Okay.
It's a little bit hard sometimes because you'll have like 5 deals that are going at the same time. You're bringing them all to market. 3 or 4 are hitting really well, and then you got one that's lagging. It's like, what's going on there? It's just a mix of timing, location, transportation. How far is it? But yeah, we've had some really good ones in Williamsburg, Greenpoint. Long Island City, we're working in now, which is I think I'm excited for. Or I know I'm excited for, just because it's a great location that we haven't really gotten access to very much. Because it's even like with Park Slope and Prospect Heights, it's hard to find good deals there. Mm-hmm. There's a lot of competition, but there's also limited inventory. You've got to navigate landmarks. So it's like, where can you find that good deal that makes sense?
Got it.
And it's also depends on the timing in the market. It's like, for me being the small to mid cap guy, there's always, and you guys know this, like there's 10 of us that all do similar stuff in North Brooklyn, 20 of us, and it's like, if I missed out on the deal, it's like, who got it? We all kind of follow each other. We all know what the other one is doing.
For sure.
And it's always kind of like, what did that person do with that? It's like, how did that work out? It's like, oh, that guy did something interesting that I wouldn't have thought of. And it's always kind of, you go a little bit of that, and you kind of learn from that as well.
Yeah, I think
get that.
certain buyers had advantages, right? Like being easy to work with.
Yeah.
I think from a broker standpoint, we obviously gravitate towards you. There's people that we gravitate towards depending on how it goes, right? Like the drawn out closings, all that annoying stuff. People do that.
Yeah,
it is what it is.
As you get better and better, right? Just like you with developing buildings, as a broker, you get better and better at like vetting out like who's the syndicator, who's the guy who actually has cash on hand.
You have to have a big advantage though in like this Italian section of Williamsburg, right? Growing up there, it had to work out well for you. People know who you are.
Yes and no.
Okay.
Sometimes they don't want to sell to the guy that's the local guy.
Really?
Because they feel like they can get more from someone that's coming from, they're looking at an address or, feel there's more capital. So it really depends. But yeah, it's tricky. You never know. Sometimes, a deal will die and it pops up 6 months later and you're like, oh, that, or a deal will die. And it's like, you'll see someone else pick it up like, oh, thank goodness we didn't do that. The timing didn't work. But I never, when I was starting, like the first 10 years, I didn't appreciate the sales team developer relationship as much as I do now. because you're just fighting for deals. You're trying to build a track record. And it's like that first deal you're doing in, the first few deals you're doing, for me, like 04, 05, I had no money. I didn't have the equity raised. So it's like, okay, I got to try to sell a deal. I got to secure a deal somehow. And then, you might want to try to delay the closing a little bit, and that just pisses everybody off.
Yeah.
But you don't really have a choice. But now it's like you get into this groove and you kind of just mature in the business itself. Now it's like, okay, if there's a deal that makes sense, we can move fast. And that's, I didn't realize that early on, because you're just trying to scramble and hustle for anything you can do.
Yeah, I won't forget, for us, I think we did that in 17 with you. Or that one, you and the other guy that lost the deal, you guys moved very, very quickly on that deal. I remember how fast that went.
Yeah.
And I think it was probably a rare deal being a 50-footer, and that block obviously was not what it is today.
Yeah.
It's obviously good on a map, but it's crazy now.
No, and even looking back, that was one of my favorite projects to do. Like the way it turned out, we were really happy with how it got a great response to the market, because then ultimately that went to market in 2020. It's not the best time to bring condos to market, but it got a great response because it looked good. It was a great location, and we were really happy with it. Really.
So that was a project that really worked out.
Yeah, it was great. You drive by and now you walk by, it's like it holds up.
For sure.
It's always nice to kind of look past, for us, and for me in particular, because you do a lot of deals in the same area. Like I think I've done probably 20, 25 deals in Williamsburg and Greenpoint, so you kind of see them everywhere. It's like, okay, that held up. This one kind of the aesthetically kind of held up well, finishes held up well, residents are happy. So you're always trying to adjust and kind of see what works, what doesn't, because it just helps you on the next one.
We hear from a lot of developers like, oh, we can't do that, it's MTA or this. Like, we sold deals on obviously a ton on Manhattan Avenue, Metropolitan, Grand Street. What are like the no-nos as a developer? Like, I'm not doing that. Like, you hear like the MTA stuff, water level tables. Like, what in your opinion, what's something that you won't touch?
It depends. I used to be scared of MTA early on, but then you start to do a few MTA deals. And okay, this is not that bad.
Okay.
You just need to know what to do. Who do you got to reach out from the MTA? You got to get them their drawings. You got to get them drawings early to get approved. You got to get your insurance requirements in place. You've got to budget a certain amount for MTA oversight. But once you have that, it's not bad. You just got to know how to do it. The environmental aspect. You've got dirty soil. You've got to clean that out. Doesn't bother me. Because you have the teams for it. You just got to budget and you got to plan for it. It's like, okay, if I'm going to turn around this deal in 3 years, the first 3 months we've got to be pretty busy and just make sure we get it done right and you budget for it right. But what scares me the most now, I don't know. Piles are always tricky.
So explain to me the piles, because obviously we don't do this.
Yeah.
So when do you do piles? What are piles? Like, how does that work?
So specifically, or more times than not, the closer you are to the water, you're going to hit water pretty quickly when you start to excavate. And you can't pour a traditional concrete foundation.
Okay.
You're going to have uplift of just from water pressure. You're going to have a dewatering plan to get water off of the site, and then that's got to go through municipal approvals. So the alternate is you're digging, instead of doing a full concrete foundation, you're doing, let's say, 40 or 50 piles strategically, in the site, and you're digging down 50 feet, 80 feet, depending on where it is, and it's just a concrete base. It's a concrete tube that gets filled, and then you pour a concrete slab over it, and then you build a building right on top.
Okay.
So it's almost kind of, you're digging through the water to support the building. And that's just gotten more expensive over time. But again, it's one of those things, if you know how to navigate it, it's not too
And this is when you push like closer to the water, like in Greenpoint.
Yeah.
That's like, you're definitely going to have to do that.
It depends. Sometimes you luck out, but a lot of times now, like with, you've got the FEMA maps and, the flood zones, you'll know kind of what you're dealing with to a certain extent. But like we did a project in Astoria where it was Halet's Cove. It's a half a block from the water. So it's okay. This is going to be piles, just because there's no chance we're hitting anything secure for quite a while. So you just have to budget for it. You have to plan for it. And then it comes to the access agreements, and you just need more of the legal side buttoned up, and that also comes kind of with experience, even dealing with attorneys and good teams in that respect. When you're younger, you're trying to find someone that or someone that's less expensive, but that's gonna hurt you. So now you got to pay for a good team that's really going to help you get you through that process. I think now it's more just about being efficient, and it's like what works, what doesn't. Can we meet our objectives to get out of here of a project in the time that we want it? Because you'll raise capital, we'll have either a syndication or fund type structure for a deal, depending on what we're doing when. And it's like we want to deliver returns to investors that are at what we said we would, or you want to beat it in that same time frame. So it all kind of ties into your deal selection. So it's never kind of just one thing. You're always looking kind of at all that stuff and how it works out well. It really kind of just depends. But there's nothing too much now. Lately it's just been dealing with rates and kind of the shock that came with it, because it had to be absorbed into the market. And sellers had to acknowledge it at some point. We had to acknowledge it. And then on the sales side, on the cap rate side, you've got to acknowledge this is what the market is, for that building. Regardless of what your pro forma thinks it should be, this is the market. And it works or it doesn't, And that takes a little bit of while, some time to just
digest.
Yeah, it's like this is what it is. Especially because rates went up so fast.
Yeah.
But then, you go into 23 and 24, it's like, okay, we know what the rates are. If the deal works at these rates, great. If it doesn't, you can't plan for the rates to come down and that will do well. It's got to work well at that price point.
What about like the retail corridors? Are you like Metropolitan or Manhattan? Would you build on these streets, or is it something you stay away from?
No, we've done a few of them on Metro. I think we've done 3 or 4 deals on Metropolitan.
Yep.
Manhattan, we've done one. It's okay. It just depends. Like, sometimes, especially in Greenpoint, the side streets are even narrow or super narrow. Like, we have one on we've done a few, I think 3 on Newell. It's a tight street. So sometimes it's even worse than like Manhattan Avenue, just because it's so tight and there's not a lot of room. So you just have to plan for it. And it's like, what can I build here, and how am I going to get material in and out? It's just really the planning phase and just being realistic. I try to avoid hoping that something's going to work out. Just like, instead of hope, it's like, okay, this is what we need to do, and does it work or does it not?
Mm-hmm.
When you're building, this is separate comment, but when you're building up like an alt-1 job, right? Like your deal on Richardson, where you're turning like a 3 into a 7, for example. Do you need access agreements for that stuff from the neighbors when you're building up, or is it only when you're messing with the foundation?
No, you need it for when you're building up as well, because you've got to provide overhead protection for those neighbors.
Got it.
And it's always, it always depends on how you approach the neighbors.
Mm-hmm.
You can go straight legal, which in some cases you need to, but sometimes it's a conversation with the neighbor. It's like, hey, we're going to be doing this for a couple months. You try to pay them for the time or the space that you're going to be using, and a lot of times people will work with you.
Mm-hmm.
So it's just sometimes just having that conversation. Bring them, muffins or whatever it might be, but just try to be honest and be nice. And I think the biggest thing that we've noticed with access agreements is just telling people what's going on, because they're like, if especially like in these parts of Brooklyn where you've got kind of people that have been there for 50 years, and they're not happy that any developer is there, but it's like, hey, this is what we're going to be doing. Here's my phone number. If you have any issues, give me a call. It doesn't matter what time it is. And it's like, hey, we're going to have we're doing demo today, this week. We're making a little bit of noise, but we'll be out of here by Monday. And so just so they know what's coming, sometimes is a huge piece, because otherwise, if you don't tell them, they're calling the building department.
Yeah.
They have the right to do it, and that's great. But if you can avoid those kind of things, because it's just delays. But it takes a little bit of time to figure out if
some of these developers act the way they act with us, with their neighbors, I can only imagine. Because they don't tell you everything, and it's always like,
communication is everything.
Yeah,
it calms everyone down.
I can only imagine like some of these developers that they don't tell these people anything probably, and then all of a sudden like things are falling on their roofs. They're calling DOB.
Yeah,
it must be nuts.
Yeah, and then if you have they have a good experience, a lot of times then they'll be like, hey, do you want to buy our place?
Yeah.
Or I'm thinking about selling. What do you think? You have a more friendly rapport.
We met with 2 people in the last month that were like, my neighbor, I hate them, what they did to us, and they're going to sell, like a development site, and their neighbors were developers.
Yeah.
They have no shot at getting that deal because they pissed them off so much, which is insane to me, because like if they just were nice, even that deal we sold Metropolitan, they were never going to sell their neighbor.
Yeah.
Just crazy.
And developers get a bad rap, and sometimes we deserve it.
Yeah.
A lot of developers are a-holes, and but if you try to do decent by everyone,
Yep.
you can avoid a lot of the headaches.
For sure.
Especially like even when you have people that move into rentals or people that move into condos, it's like just you got to you tell them, hey, this is what's going on, this is what we can do, and you navigate it.
For sure.
But a lot of times it's the simple. Even with lenders, it's like, hey, this is what's going on. This is what we're planning to do. Mm-hmm. For us, it's a lot easier now, just because we've done so many deals. And they're like, hey, have you done something in this area? It's like, yeah, here's 5 projects we've done within 2 blocks of here, and they can walk by, they see what we've done, and then it just makes it easier. Just over time it gets easier.
Where you they probably don't want to say, but where are you seeing condo prices these days? Like where do you like pro-forming? Do you think in these like Italian neighborhoods of Williamsburg?
It depends, so for a long time it was like Williamsburg always had the upper hand over Greenpoint.
Yeah.
And Long Island City, and then Long Island City kind of shot past it. Okay. Like if you're in prime Long Island City, that's a great spot to be in. And then Greenpoint has taken off. Greenpoint, some stuff that we're doing now is $1,500-$1,600 a foot. You're maybe $1,400 to $1,500 a foot on a walk-up. Which that was kind of $1,200 was usually pushing it for a few years, and then now you're starting to enter into that range.
In Greenpoint.
Yeah. Block by block, kind of really depends on the location. But even the rental side, where rentals shot up in Greenpoint significantly faster than some parts of Williamsburg. And it works out really well. If you're, the best part of any development project is when you have, your sales team, you're about to go to market, and it's like, hey, we're about to bump prices up 10%. It's like, oh, this is great.
For sure.
Wasn't planning on that. My pro forma has no mention of it, but this is great.
Yeah.
Even if you end up somewhere in between, it's always a nice thing to have. And, for a while when the market was tougher, you didn't see that, but you're seeing that more now. And like I was saying earlier, I think it's just going to start to continue.
Luke and I renovated a building in Williamsburg like a couple years ago, and our original pro forma numbers for the bank versus like what we started to think that we were going to get and what we actually got, it was just like up and up and up.
Yeah, it was crazy.
It changed so much.
I mean, the rental market exploded.
Mm-hmm. Yeah. But it was a great feeling.
Yeah, no, it's great. And then you have like an open house.
Yeah.
You launch a building, you have that first open house, and you've got 50 people there. It's like, this is great.
Yeah.
People like the product, they like the location, and there's a market for it. It just makes everyone feel a little bit better about what you're doing, makes investors happier because they know, okay, we're getting our money back soon, we're going to do okay. And it just kind of builds that kind of faith in the overall team.
Yeah.
Do you think are we hitting 2,000 a foot in these locations yet? Or close to it?
It's tricky. I've thought about that.
Yeah.
Because it's like, when the market was really slow after Lehman, and Lehman was kind of its own thing, but I was like 2012 to 15, that part of Williamsburg, which is kind of like on the other side of the BQ, on the east side of the BQE, started to kind of hit 1,200 a foot, 1,100. It kind of broke 1,000. That was the big thing.
Yep.
Now it's kind of 14, 15. The next logical step is it's going to go there.
I love that neighborhood. I mean, you're not in Northside. You're on the other side. There's amazing restaurants. You could park your car. I mean, you used to be able to park your car. And there's construction on every block, which is probably the worst part about it. But you're right there, like a Frost location, like we just discussed. Like you're essentially in Northside.
Yeah. Well, that location, you're going to hit 2,000 pretty fast. If not now, depending on what you're selling. It's just been this slow buildup, and like you guys were saying before, the prices have stayed consistent throughout the rate hikes. Mm-hmm. Now rates are coming down. Your mortgage is going to go down half, but you're still at the same price point, and you've got all this pent up demand for people that have been renting instead of buying. It's only going to go one way. There's not that much inventory.
It's going to go one way.
Yeah.
Yeah. We're seeing from a sales point.
The 421A aspect of like how long that took to get resolved, or even
45X.
Yeah. It's not really resolved. To me, it's
not really resolved.
It's jammed up the pipeline. There's not much product, and that's where some of the smaller buildings, if you can get them, they do well, but you have to be able to navigate and move quickly.
You think the 421A and the 485X and the jam up of that and what that's done to the rental market has boosted sale prices on condos?
Yeah.
Yeah.
Yeah, because I think there's less inventory.
Less inventory, yeah.
It's weird kind of with rent stabilization and all these sorts of things. You've got, I have all my theories, which probably don't sound so good on a podcast, but it's kind of like the more kind of that work kind of gets jammed up in politics, it's just everything else is going to go up.
The supply.
Yeah.
Yeah.
And stabilization and protecting housing is good, but it only protects a certain amount of people, and the rest of the market is free market.
Oh yeah.
So it's just
Good cause eviction is jamming things up too.
Yeah.
I'm seeing tenants that are not leaving and they're saying we got good cause, like we're staying.
Yeah.
And it's just like creating less supply in the market.
Mm-hmm. And that ultimately that doesn't help that many people in the market. It's like, I was looking at this. I was reading this article where it's like, okay, there's 4,000 apartments in New York City, roughly, right? And then you've got 900,000 are stabilized. Okay, the free market population is a lot of people.
Oh yeah.
So and then rent stabilized apartments, how many of them are actually for people that need that assistance? A lot of them are people that can make a ton of money, and they found that apartment, good cause, like, I'm not moving.
Yeah.
And in the meantime, you've got 3 million apartments, 5 million people that their rents are going out of control. It's a political thing that
It's so not fair.
But it kind of is what it is.
Yeah.
There needs to be a happy medium. I mean, obviously we're on one spectrum in New York, but then you look at like places like Austin, Texas, where they are like, build whatever the hell you want, and like build these skyscrapers, and I think they have an oversupply.
Yeah.
And here we are in New York, where it's way too regulated, and we're pushing pricing.
Yeah.
But they need to come back a little bit more to the middle, where that's where I think a market needs to be.
I think eventually it'll get there. It's just
Yeah.
a question of when. I think, you want to do well for everyone for New York to thrive. New York is built that way.
Correct.
You need different levels of income in the city, but the policies need to help everyone. And kind of find that midpoint where it's not just a political buzzword that it's got to work well. But New York has always kind of gone through these cycles, where things squeeze, then people realize they've squeezed too much, and then it kind of gets looser, but it just kind of ebbs and flows. But what it does for what we do, it helps because it pushes everything up. So it works out well.
Absolutely. Yeah. That's the way things have gone. All right. Well, we've been talking for a little while. Maybe just towards like wrapping up. Just two quick questions. One, I wanted to ask you, like, I've heard from like GCs that building for rentals is different than building for condos. Like, say that you rehab a building.
Sure.
But what is that difference between building for rentals and condos? Like, I get it if it's like flooring or cabinets,
like material,
and appliances, and fixtures.
Yeah.
But is that it, or is there like more to it?
Well, you've got more legal cost with going for a condo. You've got to go through your offering plan. You've got to go through that whole process. There's a time element that's tied to that. But again, you can get through that pretty quickly, but it's an extra cost. Then you've got your finishes. Are you putting in a Wolf Sub-Zero or a Bertazzoni oven, or are you putting something a little lower end for a rental? Construction materials, how fast you're doing your superstructure, because a rental you're going to want to get to market faster. So it's going to be usually stuff that's easier to execute, especially with a rehab. You can adjust, between steel, concrete, joist, all these kind of things to adjust your speed, but it also affects your price point. And then contractors always kind of price things differently. They've got their magic numbers that they work with, but they always kind of value them differently. Mm-hmm. Are they building the same thing? In a lot of ways, yes, but they look at them differently.
Yeah.
And then you also need a contractor when you're doing condos. There's more diligence on the back end with buyers. You've got punch lists. You've got to make sure things are done properly. The building is tight. Everything works well, and the contractor has to factor that into the budget. Where, okay, I have to give a warranty for this building, and I need to be on the ball to do it, because there's legal ramifications for the sponsor if he doesn't. So that factors in a little bit more, less so in rentals. So it's like a little bit of all these little things that kind of have to build up.
Yeah, like the end punch. Think about that. Like, people will rent apartments, but like to spend $2 million, like you're going through that place. The contractor's going to be.
Bringing an inspector.
Oh my God!
You're bringing an inspector. You're bringing your aunt, your uncle. You're bringing 5 different people to the.
Yeah.
You're bringing everyone to that. Especially if you're a first-time buyer.
Yeah.
And everyone is going to have like the stickies and kind of put it everywhere, and it's it's the nature of the business, but the contractor needs to work with you to kind of really make sure you address those things and that buyer is happy. Because if the buyer moves in and they're not happy, it causes more problems for you, for the developer, and you get a bad rap, as a result.
You guys have any other questions? I just got one last one.
I'm good.
Yeah, I'm good.
All right. So, what's your favorite part of a project, from like acquisition to like selling at the end? Like, what do you like the best?
That's easy. It's the chase.
I love that.
Yeah.
It's finding the deals that make sense. It's like, all right. Or if it doesn't make sense at first, it's like, how can I get this to work well that someone else might have not looked at it this way, but I can maybe try to find a different way to make it work.
That's the architect.
Yeah, that's a little bit of that part to figure it in.
Yeah.
But it's like the numbers make no sense on this.
Yeah.
What am I not missing it? It's the chase. It's like when a new deal comes in, it's like, oh, this place is great. It's a great location. How do I get that to work?
Yeah.
And then
It's great.
The end is nice, but it's the chase.
This is like what we were talking about a couple weeks ago. Just like the chase, like right before you get the deal, the in between. How do you are you going to get it?
Yeah. And then sometimes it's like you chase too much, and now it's like, okay, I've got 10 deals that I got to get built.
Yeah.
But because I enjoy that part first. Now I got to go through the messy phase. I got to actually build it.
Yeah.
But yeah, it's the nature of the business. But the chase is fun.
Cool.
Awesome. I love that answer.
Yeah.
It's
All right,
true.
this is good stuff. Looks like the market's about to go up, and there's going to be, I'm sure, more deals because of it.
Yeah, hope so.
Yeah. But Anthony, great seeing you. Thanks
Thank
so
you.
much.
Appreciate it, guys.
All right.
Thank you again.
Thank you.
All right.